I wasn't looking for a new strategy. I was just scrolling through the charts like what I always do. But then something caught my eye. A pattern, a movement I had seen before but really never paid attention to. At first I ignored it, but then it happened again and again, and that is when I knew I had to test it. So I went all in. I tested it over 100 times on different assets, Forex, gold, commodities, you name it. The results? Mind-blowing. This is a 15-minute trading strategy using moving averages only and market structure. It is simple, powerful, and effective. After months of testing and refining it, I finally have the confidence to share it with you. If you trade Forex, indices, or gold, this could be a game changer. Yes, of course, I do not promise 100% accuracy rate, but this is an edge that can actually give you profit over a series of trades. Let me break it down for you step by step. Let's dive in. Alright, so this strategy works on all tradable assets. It might be gold, indices, commodities, whatever that you like. What you are going to be requiring are basically two EMAs, which is the 50 EMA and the 200 EMA, plus a knowledge of market structure. So I'm going to show you what market structure is, whereby we all talk about higher highs, higher lows, or lower highs. So basically, when we have a lower high or a lower low, we expect to create another lower low. So on my chart, I have this blue line or blue moving average, which is the 50, and this white moving average is the 200 EMA. What we need to do is to basically find a touch of the 200. So our starting point or our origin of analysis should always be a retest of the 200 EMA. So like in this scenario, we can see that the market came to the 200 EMA at this particular point. So whenever we get this retest to the 200 EMA, the next thing is now to find a retest of the 50 EMA and basic closure of a candle above that 50 EMA. So in this case, we can see an impulse to the upside and then a retest of the 50 EMA and then closure of the market above that 50 EMA, which occurred here. So in this scenario, we are saying 1, 200, 2, retest of the 50, closure of the market above the 50 EMA, and then entry right to the upside, stop loss right below the structure. All right, so basically we need to find or to see several examples for us to understand so that we can apply this in our own charts. Right? So in this particular case, we can see as well there was a retest of the 200, which occurred here. After retest of the 200, we can see that the market went to the upside with this particular impulse, and then it retested the 50 EMA in blue, and then this happened. So all this is done on the M15 time frame. I'll find a lot of comments in the comments section. What time frame are we going to use, and can I apply this on this particular time frame? Please try to stick with the rules of the strategy. If you are someone who cannot hold that particular short and small easy rule, then you will not be able to actually implement it in the long run. All right, so that was another example. And then going forward, we need to find a retest of the 200 EMA, which also occurred at this particular point. Retest of the 200 EMA, and then we can see the market went to the upside like that, breaking the structure. For those who want to understand what market structure is, it's basically creation of a high and then pull back to create the higher low like this. So closure above the candle, above the 50, and then the market went our way like that. So that is the simplest way you can trade, especially high volatile pairs. But we are saying there are also instances whereby you are going to lose. Like in this case, we can see that the market was now in the downward move, and there was interaction with the 200 at this particular point. And after that, the next thing was now to anticipate entry after pullback. We can see the break of structure that was issued, pull back to the 50, and after that pulling back to the 50, you can see candle that closed below the 50 soon after retest, and the market went just a short period of time. We can see that when you are basing your targets from the previous examples, this was going to reverse against you whilst you are in the trade. So basically, these are points whereby you can actually lose some money. All right, so basically that is how you'll be trading. Interaction with 50 up an impulse and then pulling back to the 50 EMA like that. If you want to learn much more and intrinsic details within these particular strategies, you must join the top 1% traders course. I'll leave the link in the description box below. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.